Hi everyone, welcome to Anything with She TV. Today we will be discussing about low risk investments. Yes, these are the investments or instruments that you should put your money if you're expecting your money to be used within a year time frame and you're looking for a very low risk investment. So are you ready? Let's start. So I'm sure many of you have a lot of cash. That's why you're watching this, right? You have cash in the bank and you're thinking, where can I put my money? I mean, it's just there, it's not earning interest. So what is the smartest thing that I can use my money? So in investing, you have to understand that you are actually lending your money to investors, right? You can give your money to the government and then the government use that money and then in return they give you interest. You can also put it in the bank. They can use your money to lend it to another borrower and then in return they give you interest for holding that money. And then another one is the companies. So companies can issue bonds or preferred shares and in return you get coupon rate or dividends. Remember the last video that we had, we say that the higher the risk, the higher the return. The risk-return trade-off. In this session, we are actually considering two factors in terms of risk. There are a lot of factors that contribute to the risk of an instrument, but we will just tackle two because this is the easiest. Okay, first is the issuing entity. When you say risk of issuing entity, this is the risk wherein you evaluate if that entity will actually be in default or will be able to pay you back. So in this case, as you can see, the risk for government is the lowest because a rule of thumb or in any other countries, there is an assumption that the government will always be able to pay back. So usually they are risk-free because if the government defaults, then that would result to an economic collapse. The next one is the bank. So banks usually have higher risk because it's owned by private companies. It could be owned by the state as well. It depends, but at the end of the day, it is less risk than other companies because of its liquidity. It means the business is about money, so they're supposed to manage the risk. They're supposed to have enough liquidity or money to give it back to you, so they are definitely gonna repay you. And then the last one is a private company. Of course, private companies tend to borrow monies to fund their purchase orders, inventories, repayment of loan and everything else. So in that case, the risk is higher because they are supposed to operate and there's a lot of things that could happen in a business. Like for example, right now there's coronavirus. The airlines are definitely gonna lose money, so that's the risk. You can never tell what's gonna happen next. The next one is the tenor. Tenor is also called maturity date. If you let your money be borrowed, it means that they need to use that money for a time frame that they actually borrowed it from you, and in return they will give you interest for that. So for example, in the case of this one, the 30 days has lower risk, 6 months has higher risk, which is 2, and then 12 months has even higher risk. Doesn't mean that these are the only tenor that you will encounter in your investing life in the money market, but this is just a sample that as the longer the tenor that you invest into, the higher the interest. These are the financial instrument that you should know that you can invest to, and I will discuss as well if you can actually invest on it or not. So first, the government is able to issue Treasury Notes or T-notes. When you say T-notes, it's usually 1 year or less in tenor. If it goes beyond 1 year, it's called T-bills and T-bonds, but we will discuss that later on. Another instrument that the government issues is SDA, or it's the special deposit account. Apparently, this too is not accessible directly by small investors like us. Like if you have 100,000, you cannot directly go to the government and say, I want to buy T-notes. Usually it's also bidded, so definitely you need a bank to do the transaction for you. Okay, for shorter terms, bank can actually issue time deposit and UITF. Time deposit, I'm sure you know this already. You know that for time deposit you cannot actually pre-terminate it, because if you pre-terminate it, usually you pay more penalties than you will earn in interest. So make sure that when you put your money in time deposit, you are sure that you don't need it. Otherwise, it's a waste of money. UITF, Unit Investment Trust Fund. It means that it's a fund and there's a fund manager that will invest for you, and you just have to put your money. It's a pool of money from different investors, and when it's bigger, of course, it's easier to invest, or you can actually get those instruments that are not accessible for small investors. So we will have a separate discussion about UITF in the future, but like I explained a while ago, Treasury Notes and SDAs are accessible using UITF, and usually those funds are called money market fund or short-term fund. So look for those two. Those are the less risk, or low risk investments. They only put the fund on low risk investments, the instruments that we are discussing here. Okay, private company can also issue this instrument, and it's called promissory notes. Promissory notes are not accessible by small investors because, you know, companies doesn't have the capacity to talk to like 1,000 investors and ask for their money. That's a lot of work for them. That's why through a fund, then it's easier for them, because they just need to talk to one person and you can access higher interest rates. This is the first part of the low risk investment. Stay tuned for the next one. We will be discussing in details the time deposit and UITF. If you like the video, please subscribe. If you don't like it, I hope you still subscribe. And thank you for watching, and see you in the next video. Bye.